This is Cat's Meow, and this will probably be one of the most important videos about trading you will ever watch. Today, we're going to talk about risk and reward and position sizing. Literally the only thing you need to know to be a successful trader. So let's start off with a story. You've been going to the carnival a lot with your friends and family, and you've noticed this carny running a game, and it's a coin flipping game. And it pays out 2 to 1. So every dollar you give the carny, if you call the coin right, you get $2 back. Well, the thing is, you've been going to the carnival so much, you've actually noticed after watching maybe 10,000 people play this game that there's actually a slightly higher chance of it landing heads. In other words, the coin is weighted. Now you get excited because you think, oh, this is great, I can totally scam this game now. Well, the work doesn't stop necessarily at how you get a statistical advantage in your play. It's how much to size your position, right? So let's say we play this carnies game, and we're betting on heads because we know it's more likely to come up heads. So we get too excited and we bet 100%. Oh, well, now we have twice our original money. So if we bet the carny $100, we have $200. We're doing pretty good. Let's keep playing. Wow, now we're up to $400. We're at like Wall Street bets levels right now. Oh, now we're bankrupt because we bet 100% of our position. So we can see why it's obviously important that we need to size our positions, but how do we size them? Well, there's good news. There's actually a mathematical formula for this. So this is a great article on something called the Kelly Criterion. It's very important, but for some reason they don't really teach it a lot in economics or business school or anything like that. I went all the way through business school without ever hearing it once. The first time I had ever actually heard of it was playing poker in Las Vegas. But basically it's a formula, and there's some complicated math behind how it's derived. It's not important to know how it's derived. It's only important to know how it's used. So when we use the Kelly Criterion, there's two things we need to get a handle on. And one of them is going to take you longer than the other. So you can see we need two inputs here: our probability of win and loss, and our profit of win, or our profit when we win and our loss when we lose. Now we can control our losses, which is why I always tell everyone in chat it's so important to have a stop loss and a take profit. And you can handle the take profit in different ways. What I like to do is when I enter a trade, I already know what my stop loss is going to be, and that's the first thing I put in. And then I also have in mind a take profit. But I don't necessarily just sell off the position right away. I move my stop to that take profit level. And then once it's gotten over my take profit, I kind of let it trail, right? So I have a minimum profit for every trade I'm looking at. If I can't hit it, then I'm just going to absorb the loss. And then our probability of winning and losing comes through a lot of experience. The best way to do that is just to record all of your trades on a daily basis and classify them differently. For example, I scalp and I do weekly swing trades. I classify those differently, so I have different probabilities of winning each of those so that I can size them differently. For example, my win rate on swing trades is much higher than it is on my scalps. Now, all you really have to do when you first start is you're going to assume your probability of winning is only 51%. You want to give yourself the most confined range possible until you've calibrated and you've recorded this information. You've actually come up with realistic win rates for your strategies. So when you punch numbers into this formula to figure out what your ideal position size is, you're going to start off with your probability of winning just being 51% and your probability of losing being 49%. And you're going to do the exact same for your profit and loss. So you're not going to assume that your trades are significantly more profitable when you win than they are when you lose, just to be safe. And then when you get a better idea of the expectations of the kind of trading you're doing, you can recalibrate these numbers and get better. That's why a stop loss is so important, especially when you begin trading, is so you can calibrate this. So what you're going to do is you are going to take your percent chance to win and subtract it by 1 minus your percent chance to win over your ratio of profit to loss. So in this case, that would be 0.6 minus, and then in parentheses, 1 minus 0.6 over 0.2 divided by 0.2, which is just 1. And that should give you about a 20% asset allocation, which is kind of irresponsible, honestly. To new traders, I would say use about half of your Kelly Criterion and then scale up as you get better. And I'll go ahead and put a link to this website in the description also. So I've gone ahead and created a small spreadsheet just so in this video I can show you generally how you can get different numbers depending on what your probability of winning is or what your profit is. So you can see right now we have plugged in the default 1-to-1, and our probability is 51% of winning, 49% of losing. Our profit when we win is 20%. Our loss when we lose is 20%. And our Kelly Criterion that we get out of that is around 2%, which, like I said, you should divide that in half when you first start trading. So for a new trader, I would recommend, based on this criterion, position size about 2% of your entire portfolio, or what you're willing to trade, or what you have in your account. So let's see what happens when we can raise our probability up a little bit. Let's say 80% chance to win, which I think I have about a 0.75% chance on my swing trades right now. So the Kelly Criterion gives me, if I do equal profit and loss, which I don't do, basically 60% of my portfolio I can trade at once on a swing trade, which I still wouldn't do that. I think the maximum I do is like 25%. But this should give you a good idea of how to trade and not just go completely bankrupt. So let's see what happens when we hypothetically set a tighter stop loss. So we're going to set a tight stop loss here and not give ourselves very good odds to win. Actually, we're going to say we only have a 30% chance to win and a 70% chance to lose. But we're going to go ahead and make sure that when we win twice as much as when we lose. So we'll say 2.5%, and then we stop out at 1%. So we can still trade 2% of our portfolio and be in the positive. And this is just a great example of how you don't even have to be right all the time. You just have to manage your stops. I once knew a guy who, using similar criterion to this, designed a bot that would basically flip a coin on whether or not to buy or sell at the beginning of the day. And the bot was still profitable just because it stopped out at 1% and then it took profit at 2.5. So let's see what happens. Let's say we profit an average of 5% on our scalps and we only risk 1. And let's take, I'd say probably about 63% of my scalps right now are winning, and let's see, 37% are losing. So Kelly Criterion still says I could trade about half of my entire balance on each scalp, which I wouldn't ever, but I could theoretically do it and not go broke. So another factor here is a lot of times in the Discord I talk about plays I take purely for the risk to reward ratio. And how is that calculated? You can calculate that in a number of different ways. I am a primarily technical analysis based trader, so I'm doing it purely off my supports and resistances. And I'll give you an example based on today. So when I talk about plays I make purely for the risk to reward, I'm talking about situations like this, where my nearest range of resistance is right over top the market price right now. This isn't quite accurate. It's right around there at around 294. And the nearest range of support I see, major support, is around 266. So essentially I can stop out at like 300, and could potentially ride this out to 266. I'd probably use a trailing stop, so it's unlikely that it'd get all the way down to 266, but my risk to reward makes sense because I'm buying at probably the closest to this resistance I probably could, and the farthest away from the support I probably could. And I only really have to have a stop somewhere around 300. So if you calculate the difference between that and the market price right now, it's almost $30. So let's say I shorted one share. I'm risking $5 for a potential gain of 30. That's 6 to 1. So when we go back to that Kelly Criterion and look at that ratio, I don't have to be right there that many of the times. The win is so big that I could potentially lose this trade 6, 7 times in a row and it'd still be profitable. So that's when I might pick up, just purely for the risk to reward. And then I'd stop out at 300, and I wouldn't worry about it that much because there's not a lot of fundamental technical analysis behind that play. That's why I say it's a purely R&R trade. All right, guys, that's it for the risk to reward video. I hope that gives you a good introduction of what I'm talking about when I talk about R&R plays and why it's important to always have a stop loss. If you want to use any of the same charts I use Webull. There will be a referral link down below. And this video was really meant to be a primer. I highly recommend you read as much as you can about risk to reward and position sizing and value betting and that kind of thing, because it's really the only important thing to know as a trader. The technical analysis we do, the due diligence, is obviously all to increase our odds, to increase our win rate, but you can be a profitable trader purely trading randomly, as long as you have a good understanding of risk to reward, stop loss, why you need a stop loss, and position sizing. All right,